Okay, good evening, everyone. So let me welcome you one more time. Welcome to the Korea Society and the Startup Scene Entrepreneurs of Tomorrow. It's really wonderful to see many of you here on 3050 Madison. And also I'd like to say hello to those joining us at the Korea Society channel on YouTube Live. And I'm Sojang Kim, and we've exchanged, many of you probably, I've exchanged an email confirming your participation. And I'm a director of the Business and Economics program here. And I'm so excited about tonight's program. So since 2024, with the exclusive support of Hanwha Life, Startup Scene has featured, actually I counted today, over 50 voices across the startup ecosystems through our in-house programs and annual forums. And our goal is to make this platform very meaningful, to make it as for the founders and investors and innovators connect together for the better idea and learning the trends at the startup ecosystem. So for that sense, we are always trying to hear from our participants in terms of the topics. What kind of topics do you want us to cover? And one of the topics that we hear so many times is, let's hear more directly from VCs and more direct insights from VCs. So tonight, we are answering that call with a timely focus on momentum. So in an environment where AI startups appears on almost a daily basis, and some, according to my YouTube algorithm, is founded by high schoolers, and is always admonishes, what are you doing with the AI app? You have to use it better. But anyway, so we are living in that environment right now, and the question becomes clear to us. And how do we distinguish hype from true staying powers? So to answer this question, we've invited diverse panelists from the VC sectors. But before we dive into the topic, I'd like to invite Tom. He wanted to say hello, and Tom is the president and the CEO of the Korea Society. Let's welcome him.
Thank you all for coming here this evening. And I have to say that Sojang and Sarah have put on a lot of tremendous work into this series over the past 2 years. It's one of the highlights of the Korea Society's programming. So so I just wanted to say that, make some brief remarks. It's been a pivotal summer for the U.S.-Korea relationship. There are new trade agreements. There's the new trade agreement, tariff revisions, disagreements on digital regulations affecting U.S. tech companies in Korea, and revised semiconductor export controls on Korean companies. So the Korea Society has been following these recent developments. It has also followed the recent bilateral leaders meeting in Washington, D.C. And I think it holds promise in the relationship, despite some of the concerns I just mentioned, between the people, and not just a relationship, but also for broadening of ties between the people of Korea and the United States. And the two leaders in Washington, I think it was last week, seems longer, affirmed the importance of maintaining a robust alliance. There's promises for a step up in economic cooperation. And I think this step up in economic cooperation will probably include greater opportunities for innovative finance. Against this background, it's a great pleasure for me to introduce today's program, Startup Scene Entrepreneurs of Tomorrow. So as Sojang mentioned, the theme is Riding the Momentum, How VCs Navigate Hype and Sustainable Growth. Of course, very relevant in today's markets. I'm especially grateful for our distinguished panelists and moderator for bringing their on-the-ground, frontline perspective on what's real and what may be next, and how to build companies that last here in New York, across the United States, and with partners in Korea. This series is intended to benefit the community of entrepreneurs, operators, and investors who are turning ideas into reality. A heartfelt thanks to Hanwha Life for their exclusive support of the Startup Scene series of programs. So please enjoy the discussion, ask questions, and then stay for the networking session. So thank you all for joining us, and let's get started.
Thank you, Tom. So now turning to tonight's panel, did I say I'm very excited? It's because we have an outstanding group of speakers. They not only just bring the deep experience in their own fields, but I'm very excited for the broader set of insights that they're going to bring through the panel discussion tonight. So let me just briefly introduce our speakers. So first, Bryan Kim from Andreessen Horowitz. He's a partner at A16Z. He invests in consumer AI application across productivity, health, and social platforms. And previously, he played a key role in scaling Snap through its hypergrowth and IPO. And secondly, I'd like to why don't you welcome them with a big round of applause?
Claps for everyone.
They have a very demanding schedule. So actually, Bryan arrived this morning, 3 a.m. Yes. Yes. And secondly, I'd like to introduce Karen Moon. So Karen, she's wearing actually two hats. She is a two times of startup founders, and also she is an investor. So Karen, she brings over 20 years of experience at the intersection of consumer insights, AI, and design. And she co-founded and scaled Trend Athletics, and now she leads innovation at Spangle AI. Let's welcome Karen. And third is Mike Kim from Third Prime. Mike is a general partner at Third Prime, where he focuses on vertical AI in industries such as aerospace, energy, and advanced manufacturing. So he's coming with years of experience at top investment firms, and he blends financial expertise with a vision for industrial tech. And our moderating today.
There's a clap. Clap for Mike.
Okay. And today our moderator is Danny Critton from Lux Capital. He's a partner for research at Lux, and he's a former TechCrunch editor and a longtime observer of both US and Korea startup ecosystem, which dates back all the way to his Fulbright scholarship period. So he stayed at the KAIST and made a lots of connections with the startup innovation. So he is actually, I think he's the perfect guide for tonight's discussion because he brings journalism and venture capital. So, I mean, of course, I kind of shortened their bio. For full bios, please refer to our website one more time. And yes, without further ado, let's dive in.
Thank you. I can assure you I am not the perfect guy. I can assure you, so I've been oversold. But you know what else has also been oversold? Every startup out in the universe today. So today's topic is riding the momentum, how VCs navigate hype and sustainable growth. And I think we've all seen the headlines over the last couple of weeks, couple of months. Anthropic just raised, 186 billion, a series F, G, H, J. I'm running out of letters here. We saw OpenAI cross the 500 billion mark. We saw NVIDIA peak at a $4.5 trillion market cap, now at 4.34 trillion. One of the most valuable companies ever in the history of humanity. Crypto, we're seeing Bitcoin, Ethereum across the board at massive rates, and onwards and onwards and onwards. And one of the things we talked about in the green room right before this was that we're all effing tired. Sorry, I'm going to keep my language clean. Oh, we are all effing tired. We're writing checks. The speed at which deals are getting done is faster than ever. We are seeing deals start in the morning and have completed term sheets by the afternoon. We were just looking at a deal that had 44 active term sheets around the table. The speed at which AI, hardware, defense, aerospace, all the industries that we cover in all of our various enterprises is never been faster. And so the question for tonight, the question we want to answer for all of you is to talk about hype. What does it mean to build a company today in a period in which hype seems to matter more than substance, whether that is in software or hardware? And so I think I'm going to turn it over, just since you're next to me, to Mike, both to talk a little bit about the work that you're doing with Third Prime, but also you're in the industrial space. You're working on AI, particularly in the software category. This is not an industry that's traditionally known for hype, but all of a sudden people have sort of shown up. There's more and more interest here, including yourself. And suddenly, investing in vertical SaaS for factories is sexy. What changed?
Yeah. Well, I think it's a timely question. I think there are a number of top-down factors that are kind of driving it. But the way that we, I guess, synthesize all that is it's kind of a basic collision of supply-side factors and demand-side factors. So what does that mean? If you think about what's going on here in the U.S., right? If you think about on the supply side, obviously manufacturing employment, really since the 1970s, is headed in one direction, right? So we're at a 50-year nadir. And I guess when we ask ourselves, is that trend line actually going to change over the next 10, 20, 30 years? Our view is probably not, right? So said another way, I think the supply base is shrinking. I think that's reasonably well understood. And then on the demand side, for a number of reasons, whether it's reshoring, whether it's a unipolar world, obviously turning, multipolar, right? I think we've all come to the recognition that, 6 decades plus of globalization and, offshoring and outsourcing does come with certain costs, right? And we're bearing some of the costs in terms of fragility in the infrastructure base, right? Here in the U.S., losing maybe some leadership positions in certain really mission critical industries where we actually once, had leadership positions. So I think in essence, that is what's informing kind of the immense amount of interest. Like with anything, too much of a good thing can actually turn into a bad thing, right? And before kind of, addressing the question directly as it relates to kind of industrials, I think industrials represents a broader kind of, it's a microcosm of everything else that's going on, broadly speaking, right? Which is, in some respects, we too obviously believe in power law, right? It's empirically proven. It's a very powerful and critical element of venture. But I think because of some of the changes that maybe Danny had sort of spoken to, I think there's a growing sort of consensus view that power law is actually getting amplified by AI, that AI is making it even more extreme. What does that mean? That means perhaps the number of positive outcomes or the frequency of it is actually coming down, but that those that actually do have positive outcomes actually are getting greater in magnitude, right? And so I think against that backdrop, right, there's talk of, shooting stars and supernovas and, AI startups that are going from 0 to 50 million of ARR in 2 years. And what that is doing in terms of second, third order effects is it's creating a much higher bar, right, for fundability for the 99% that is not getting from 0 to 50 in 2 years. And I think one maybe example of that is just, the graduation rates from, seed to Series A being at a multi-decadal low. It used to be at sort of 40 to 50% depending on the sector, and now it's closer to 10%. And I think our general just posture as an emerging manager that's pursuing what we hope to be a pretty differentiated strategy is that there are many ways to participate in venture, right? It's not that we don't believe in power law. It's that ultimately, if we sort of back into what we're trying to do for our customers, right, whether it be capital partners or founders, we don't necessarily need to chase the $10 billion, $20 billion, in the case of Anthropic, obviously the $186 billion outcome. And I think that drives a lot of just how we approach, sourcing, how we underwrite, and the types of opportunities that we look for.
And I think to Mike's point, you're seeing this expansion at the bottom of the funnel, right? So at the bottom of this pyramid, more and more VCs are willing to fund at seed. They want optionality. They want to see more opportunities, shots on goal. And then there's a culling that seems to go in really aggressively. And to your second point on industrials, as VCs, we always want to buy low and sell high. And as more and more people enter these markets, it's getting harder and harder to find the right valuations in markets that oftentimes can be constrained. Now, I want to go to Karen here. So Karen, you have actually crossed all kinds of different worlds. You're in the growth equity space, private equity space, currently building a startup on agentic e-commerce, and have also been very focused on consumer. So you have this wide angle lens on all the stuff that's going on here, but you're fundamentally an operator right now. You're building a company. You're on the cutting edge and front lines here. How are you experiencing this hype cycle from your perspective?
So, quick question. How many people here are founders? Raise your hands. Not that many. How many are investors? Operators? Okay. So I'm going to come at this from a couple of lenses, right? So when we think about hype versus sustainability, so my first startup I started in 2013, 14, 15. That was during the digital innovation wave, right? And I think it's so interesting. So our company, we're funded, but it was growing in the last year is so interesting because we were kind of talking about this before. Actually, I think hype's over. I think we are more careful about where you're putting your dollars because we've all been through the 2021 cycle. We've all been through, unit economics don't work. I think it's different when you have huge amounts of capital going into very few companies, right? So if we think about all the funding that's happened, it's a very high concentration of companies, and that also has to deal with the capital allocation, right? We have, from a seed side, we have tons of emerging managers who've started, and guess what? They filled this void in the pre-seed, seed era because they had smaller checks to write. And so what you have is more companies getting started, but there's a huge, it used to be a Series B gap, now it's a Series A gap. So I think that's part of this whole hype cycle and whatever. But from the opportunity standpoint, and I was 2020, I just gave a talk like 10 years and now what is the difference? 2015, you were thinking, okay, it's all about raise as much money as you can, gain market share, and you'll figure out revenue, et cetera. And but we look and Flip just died the other day, right? It was like $1 billion. And there's so many of that has happened. So many people have invested a lot of money in these companies and have these scars on their portfolio track records that it's a little bit different now. So in the agentic era, we are so cheap. We've raised $6 million on a deck, right? Really good team. But we were really quiet for a while in stealth mode. And I'm telling you, everything we're doing is totally differently. When you're building a startup in the agentic era, I'm more focused on revenue per employee. So we're talking about, there's this leaderboard of what are the number of companies that over 5 million in ARR, doing at least 1 million in revenue and up. That's the new metric, right? If you want to control your own destiny, and this matters if you're joining a new company, if you're building your own new company, I think the opportunity to do more with less is so powerful. It started with co-agents, co-pilots. Now you can small discrete tasks, right? I think some of the stuff is overhyped and it still takes some time to get there, but there's never been a more interesting time to build a company and to do it differently and more profitably. So what I'll say, and I'll kind of close the hype cycle thing here is, I don't think it's all about VC money now. Before I was all about that. And look, we're VC funded right now. We're backed by Madrona. We're talking to all these other funds now. But if I were starting over, if I were starting differently, I'm super back into my private equity days, right? I'm interested in cash flowing businesses. There's a whole new startup realm of entrepreneurship by acquisition. Even tech startups that I'm advising sometime, I'm well, what if we bought a scaffolding company, and this is a drone company, right? So I'm we can raise 20 million, buy the company that's cash flow. There's so many different ways to build a company now that I'm actually not interested in traditional venture capital. And so I think there's different ways to think about building a business. And I think lifestyle businesses, making money on day one, it's just totally different. And so I think there's creative ways to think about your own, unless you're building a foundational model, all these different things, building a software startup has become totally commoditized, and it's like fashion. It's like a consumer brand where anyone can build something up. And so, maybe you join a startup, maybe you join Windsurf, but then are you not going to get part of the equity? So for me, everything's changed. Yeah.
If you look at 10 years
Don't
ago.
tell my boss. Don't tell my investors.
If you look at 10 years ago, SoftBank was launching the Vision Fund and this idea of capital as a moat. The idea was if you outraised your opponents, you had this moat that they could never compete with you. You could hire their employees. You could basically raise the gates, so to speak, and make sure that you were the only one that won. Most notably, WeWork came out of that world, which was, co-working space, places that are real estate. If we just buy all the leases in New York City, no one else can have leases. And at some point, that all tumbled down, to your point, in 2021. At the same time, though, I feel like consumer has grown faster than ever. Bryan, that's where you focused on, all the way from Snap, all the way through Andreessen Horowitz today. We're at a time when, when I was in Korea 15 years ago, I always said, Korea is unique in that you can get an app into the app store and then it becomes the entire nation's app within weeks because these dense social networks exist. In the time that it takes an app in the US, Facebook example, it takes years to get to 40, 50, 60% penetration. Korea oftentimes could do this in weeks. Everyone had Coupang, everyone had Tengun Market, or whatever the case may be, in relatively short order. But then we see ChatGPT and Anthropic, companies that since their launch in 2022 are breaching 1 billion users in just a handful of years. We're seeing an expansion in consumer like nothing before. It seems to me like there's actually a true hype cycle in consumer, even if there's an opportunity for lifestyle business and all sort of stuff. What are you seeing from your perspective?
Yeah, I'll offer a slightly different sort of point of view here. One, I believe AI is bigger than internet, potentially, and that shows up in numbers. So if you actually think about, talked about ChatGPT user went from 0 to basically 1 billion in monthly active user in 2.5 years. That's never heard of. The adoption is crazy. If you look at OpenAI, Anthropic, and their net revenue that they're adding each quarter, that dwarfs every software company combined. Just think about that. That should be blowing everyone's mind. That's insane. Mike, you talked about 0 to 50 million ARR company. Try Cursor, 0 to $500 million ARR company in 1 year. And they didn't steal market share from anyone. It just happened. People started paying out of nowhere, 0 to 500 million in that run rate. So as you think about sort of AI, we think about hype cycle, and yes, it could be hype, and there's like always a thing. But as VC, our job is to be techno optimists. We're optimistic that it'll change a lot of the way we live, work, and sort of and be to some extent. And so, if we believe AI is bigger than ever, which I think a lot of the data supports potentially, and that this is the Cambrian period where everything is just bubbling. This is the time to go really aggressive and to actually be in some of these companies. And will they all work out? Absolutely not. But 1 or 2% of them that work out, I mean, Figma went public at like some number and it's like $85 billion. Canva is like way bigger than Figma. And if you think about Cursor or OpenAI, Anthropic of the world, that's way, way, way bigger. So as we think about how the world is shifting today, the amount of, so forget hype from like, oh my God, we heard of it. Actual dollar, people are actually paying. They're voting with their wallet. When you think about that tendency and the ramp up, I don't think we're really in a hype cycle. I actually think this is real. This is real, and the numbers, not just users, dollars support that. And I think it's, we were just talking about the number of deals, like 44 term sheet, that stresses the hell out of me. Look, the companies are moving at a breakneck speed. Investors are moving at a breakneck speed. And my whole shtick these days is momentum is the moat. There is no differentiation right now because we're too early. Even if we say 0 to 500 and all the billion MAU, I still think we're early in the cycle. So right now is the time to move quickly, ship product, get users, make money. And you can absolutely do it with profitability, and you can absolutely do it with venture dollar as well. More than one way to skin the cat.
When you look at consumer, 20 years ago, obviously we had the rise of the advertising market, Google, Facebook, as mobile online display. The core of consumer was don't ask the consumer to pay. Yep. And we have totally switched. People do pay $20 a month, $200 a month. Now we're seeing talks of $2,000 a month for AI tools. Yep. Certainly at the enterprise scale, your enterprise companies, if you're a coder, buying a Cognition, buying a Cursor, they are paying that for their engineers. So people are willing to shell out wallets. Now, what's interesting is you and Karen have a very radically, I feel like, different view on building a company today. Yours is run with the momentum, go for it, throw it out, buy now, use VC, lever as quickly as possible, ride the hype cycle as much as you can. Karen, you are much more deliberate, tactical, focused on PE style, use the cash flow, be diligent, survive because perhaps there's going to be a wildfire and all these companies are going to be wiped out and whoever's strongest and has that P&L is going to survive. I'm curious how you two reconcile the two.
So actually, I'm kind of like contradictory because my current company is VC funded and we're like going all like the hype cycle. It's it's all there and yeah. So but even building that plan and the operating plan, it's more about the ROI in human talent and actually how human talent plus AI. So actually we want to do more with less, but then throw a lot of scalability into each of the people and et cetera, et cetera. So who we're hiring, who I'm thinking about, building out that operating plan, that's what looks different. That said, this company right now it's all VC funded. It's all, that's the path. But as I think more broadly about the space and about entrepreneurship, I think it's so interesting and it's a different time where there are certain types of companies that aren't right for VC, but can actually be really great wealth generation companies. And so what I'm saying here is in the age of agentic AI, that's more interesting now than it's ever been before, right? And so in the cash flow businesses, all those types of things is now if you acquire, so I'm just personally interested in acquiring companies. There's all these boomers that are leaving and there's all these small businesses, right? There's a huge market of dollars of spend of services businesses that are in the that are not going to go away with AI, and using AI and a combination of agents and people to operationalize those and turn a regular EBITDA business to like a much higher leverage. Like to me, that's interesting. So for me, I'm very much interested in AI. You can build the blocks on it. You can build the foundational infrastructure layers and application layer. But there's also this fun part of just like using it and building agents and doing things and like totally turning around an operation. So that's not what I'm doing, but I like think about it a lot. Like that's what I'm at like 2 a.m. ChatGPT. I'm always like, okay, so should I start a vending machine business or an HVAC business? By the way, HVAC multiples are super high. But anyways, like so here as we think about entrepreneurship, I think I want to open the lens of there's so many different ways to think about it. And the reason it's exciting is because of what's possible with AI. Like this wouldn't have been interesting like 4 years ago.
Now, Bryan, you're obviously a venture capitalist. You've gone through generations of different metrics, leverage on employees, these kind of new metrics. How do you think about evaluating a company today in a hype cycle?
Yes, I can square this right away, which is I agree with you. I think there are companies that don't need to be venture funded. I also think in the AI world, there is an AI roll-up strategy similar to private equity where you roll up HVACs and you add AI, you cut costs and move very quickly. And that's certainly like Thrive Holdings in New York City. They're doing a lot of that. Thrive's dangerous foe. Long Lake of the world is also doing that here in New York. So I think that's absolutely a business model. And that works and that's great. I want to keep my job and therefore build companies that VCs can fund. So that's how I think about it. The metrics you asked, it's essentially growth right now. Like if you take all the time in the world to think, oh, like what are the nooks and crannies we're gonna build and what are the nuances, it's too late because the models are gonna change every other week. It's just gonna come and your business is wiped. ChatGPT just says like, oh, like we're gonna enable X. Oh, there's this new emerging thing that we didn't anticipate and your business is wiped. So my theory is that if you don't move quicker than that, you die and you become obsolete. And therefore, moving quick shows up in 2 ways. Either it's revenue or distribution type moat, or revenue or distribution type momentum, or product velocity. Mm-hmm. These are the 3 things that I look for. Either you're growing quickly, either you're adding revenue very quickly, or you are shipping very quickly, ideally all of the above. It's funny, 2 years ago, if somebody came to me and came to us, A16Z, and said, oh, our company grew from $0 to $2 million in run rate in 3 months. Are you interested? The answer is, holy shit, that's great. Let's dig in, let's understand, etc. Nowadays, we grew from 0 to 2. I'm like, how fast? I'm like a month. I'm like, nah. It needs to be like 10 days. Yes. Like genuinely, I think met a company over the weekend, added 1 million in a day. So when you have those, it's really hard to, think, you got to think about the opportunity cost, right? You're like, am I going to work with this company that's like methodically building out the 0 to 2 thing over a year? Could be really good, could be, and that could be a theory, but a lot of times you're seeing these like really fast spoil companies. And I have the saying that like, just as it's hard to catch a falling knife, it's really hard to catch a soaring knife too as an investor. You get bloodied, your hand get bloody, you miss it and it flies. So you got to catch it quickly, and these things are just spoiling very, very quickly. So that's what I look for.
Mike, obviously we're spending a lot of time in industrials. Factories are going through generational change. A lot of factories are owned by people in their 50s, 60s, and 70s, built in post-war, looking for the next generation to take over factories, take over all of their infrastructure, trying to move to software, tough transition. But all of a sudden, we're seeing a lot of roll-up strategies, Hadrian and others, as well as on the software side, a lot of tools that are trying to empower this. How much does AI and this hype cycle affect into the industrial world? Does this matter to your world where you are sometimes literally selling to a 75-year-old in Ohio and aka my grandfather, whatever the case may be, or does this just exist on the coasts?
I think it's absolutely impactful, but I would just go back to what Karen said, which is I think we should just broaden the aperture a little bit in terms of kind of what actually is venture fundable. And I think Hadrian's a really interesting example because here we're talking about fast starts, right? That sometimes can be conflated with momentum and sometimes can be conflated with hype. Hadrian, I believe, I'm not an investor, was not necessarily that, right? It took them a little bit of time to get to some numbers that are fairly pedestrian, I guess, by Bryan standards. I mean, we would drool over those numbers, frankly, right?
Hadrian, by the way.
Right. I think just not to kind of meander, but the contextual points are really important here, right? Like when we talk about momentum, I think there are many forms of momentum. Bryan mentioned a couple, right? There's product velocity, there's mind share, there's funding momentum, there's actually commercial traction, and obviously over the long term, it's kind of like that age-old, Buffett and Munger expression, right? The market's a weighing mechanism in the long term, but it's a voting mechanism in the short term. Like I'm kind of reminded that actually applies to venture here, right? In the short term, we've at least seen lots of opportunities where those are actually not necessarily the same. Like they're decoupled, right? Where we're seeing lots of companies exhibit certain forms of momentum, but certainly not the ones that, in our opinion, are the most fundamental and the most important. So I know that doesn't necessarily get into kind of specifically industrials, but I think, to your point about industrials, like stating the obvious, like the entire process is different, right? Like compared to, B2C, RFPs tend to be a lot more complicated. Sales cycles are notoriously long, like even within B2B standards, right? And then you compound that with obviously the sort of generational kind of ownership dynamics, whether it's a 70-year-old or someone like that. And I think the general sort of like VC mantra of build fast and break fast, it doesn't actually work to a large extent in industrials, right? Just because the cost of failure is like really high. Like you can't, if you're a machine shop, right, that's trying to automate 80% of the workflows, like Hadrian is, like I'm sorry, but like building a gear to spec for company XYZ, like that needs to be pretty precise. And Hadrian's obviously doing a fantastic example of that, or doing a great job of that, but there are many that are not. So I just it's our observation that speed is wonderful. We too want I wish we had, frankly, more portfolio companies that are adding 1 million of ARR a day. We don't have enough of those, but it does come at a cost, right? And I think that cost is particularly, I would say, high and acute in industrials.
I want to focus on Bryan's comment of product velocity here, though, because I think one of the things you see in defense, aerospace, industrials, these are sclerotic, slow industries. I mean, I was giving a briefing to a defense prime leadership team, 15, 20 folks, and I was talking about Anduril, and I'm like, look, the goal with Anduril with any new product is we're going to build in the lab within 2 weeks and it's in the field within 4. And these people were like, I got to watch my language, like WTF, LOL. They were like, it takes at least 5 to 7 years to do that. And it was just a complete different experience of like, and it's not just AI or like suddenly in the last 2 years, thanks to ChatGPT, AI suddenly made this work. It was really a cultural shift, a shift around skill sets, a shift around experimentation. People grew up with maker spaces. People actually know how to combine electronics and all these sorts of things. So I'm curious when you think about just the product velocity and the myth or the hype cycle around product velocity. Do you see that in the companies that you're looking at where they're going, wow, this is just so much faster than what was there before?
I think product velocity, no matter what end market you're serving, is of course important.
Right.
I do think that in many sort of physical kind of economy end markets, I just think it's harder. Yeah. Just in terms of that translating into immediate customer conviction and customer adoption. Like one just, I'd say recent and really salient example is obviously nuclear's in vogue, right? Really timely.
We're building one on the moon.
Totally. As we probably should. And there's sound reasons for that, right?
Yes.
It's a great second derivative way of expressing, obviously, the AI revolution. We need lots of baseload, ideally carbon-free power, and nuclear is a pretty good source of that power, right? But speaking of just time and just how like detached maybe the physical world is from maybe some other areas of obviously our economy, the single biggest bottleneck on why we here in the U.S. have not obviously expanded our nuclear fleet over the last 30 plus years is because our regulations take forever. And of course, with that comes cost and of course, lots of other sort of, frictions, right? And we actually funded an AI, startup that's looking to actually automate huge parts of that regulatory compliance process, working very closely with, of course, the NRC, the Nuclear Regulatory Commission. But just to give you a sense of like what the deltas are that we're excited by, regulatory, processes historically could take decades, quite literally. Our North Star is if we could actually truncate it to maybe 3 or 4 years, that would be the holy grail. So that's a little bit different than 2 months or 1 week or even 1 day.
Yes.
Right.
Yes.
So I think product velocity matters, but I think it helps to have perhaps more measured expectations.
Yes. I will say, if you haven't looked at the length of an environmental impact statement in the United States, 1960s, they were about 32 pages to 100 pages. They averaged 2,000 pages throughout the 1990s, and they're up to, in some cases, 40 to 50,000 pages apiece. And AI, thanks to AI, we are now expanding that to hundreds of thousands of pages per project. So we will see if the AI versus the AI in terms of paperwork versus processing the paperwork ends up winning. But Bryan, earlier on, Mike was talking about the power law and how the power law is shifting. That there are more winners at the top, and it's sort of a compression. We'll call it the decline of the middle class startup, so to speak. So you have Karen's view that you have a bunch of lifestyle businesses that are very profitable, that you can build. A creator can make a $100 million revenue business with a couple of employees and AI agents that all come together, and it's very, very profitable. Do you see the same pinch point on that curve? Is that sort of what you're also seeing in the venture capital space?
I think that always existed. I don't think that's new. What is a slow-growing software company that's making 5-10 million run rate worth? I don't know. 0, potentially. Somebody's got to buy that thing. What is a social media company with 20 million daily active users that makes no money and grows slowly worse? Potentially not a lot. So I think there are many ways to die. One of my favorite things, like dumb ways to die. There are dumb ways to die. There are many ways to die. I think what's interesting, though, is these outcomes when it works is just too big. So, Mike, you said the word of there's so many companies, we don't need all of them. I think that's right. If you're a smaller fund, you don't need all of them. You just need one. We at ACNZ are a multi-stage fund with a lot of AUM, so fund size is very big, and we actually need an X% of the winners. And the winners we understand to be gigantic, right? Databricks, one of our portfolio company, just did Series K, I think. I don't even know what that means, right? So companies aren't going public. They're taking a long time. The upsides are gigantic. It's possible that Databricks is a $1 trillion private company. And we have a good chunk of that. So that's a way to understand, because these companies, the outcomes are getting so big, the commensurate input dollar can also become larger. Mm-hmm. And then the game becomes, can you find them? Can you win them? And can you work with them over time? And that's what we're seeing. And, I think the value of deaths is still very much there. And we have hundreds of portfolio companies and we do reviews all the time, and vast majority are in that zone. Yeah. What are you going to do with them? Help them sell, help them advise them, or do whatever, but it's hard. And there are only very few that returns the fund. I have a great stats from my colleague, Jeff Jordan, who was on the board of Pinterest, Airbnb, and made all these legendary investments. I think he made about 100 investments over his career. 97% of his return came from 3 companies. That's it. And he always told us, just remember, that's what we're doing. That is a game.
Does that percentage go up in this AI world?
I don't think it goes up in
99% of one company? Or,
yeah, it's possible. Yeah, I don't know if it goes up in number of companies.
Yes.
I think look, I have a friend who invests in Anthropic, Series A or B. I have a friend who invested in Cursor Seed. What is their concentration of return going to be on this name? 99.9%? I don't know. Yeah. So I think that's what we're looking for.
I think it all comes back down to horizontal and vertical. And when you think about the larger companies and foundational, like Anthropic, ChatGPT, where they built the infrastructure, but if you think about their horizontal play and we talk about rappers. You look at Jasper, it was the fastest 100 million, and now I don't want to say anything because I don't know how well it's doing now. But it's I think what's super interesting, and this goes back to Mike's point, is when I think about the world and the lens and everything, when you have mind share of ChatGPT or Claude and it can do everything, the real winners and the opportunities in businesses are ones that you have a very interesting, and I'm thinking more from a B2B lens versus consumer, but very specific understanding of niche workflows. Yeah. And I think those are the ones where they add value, where I'm right now, for my job and for work. I use everything, and I feel like I'm constantly interviewing all the different models, which one's better, which one's not, and like I create custom GPTs, but then I have to update them. It's just like crazy. And so like when you understand a workflow so well, whether it's for creator economy or whether it's for industrial or enterprise, which is like we work with all enterprise brands and retailers, like that's where you see the combination of product velocity, distribution, et cetera. So I'll give you a couple of examples and why I think the way I do around niche businesses. A lot of it's B2B, right? So if you think about, and I did this actually doing diligence on like a growth equity investment, a venture-backed growth equity investment, but I looked in the home space and then I looked at all these different apps that exist. This was like 4 years ago. There are so many profitable little mobile apps. These exist. By the way, Bloomberg, I think 30% of their profit comes from all these little apps, So if you think about what ChatGPT is doing and their app store, like if you build a secondary market and enable people to create money, like Shopify templates, all these big, I think the venture funded opportunities are going to be these big behemoths that are platforms and are enabling all this other stuff. But there's all this little entrepreneurship that can happen in these very niche, interesting verticals. So I think we're going to see this bifurcation. On our side, I can just tell you, my last company versus this company, all working with enterprise retailers. And now if I'm thinking back to numbers, that last company, we worked with companies that in aggregate did around $300 billion in retail value. I think it took me 7 years to get there. Right now, this company we launched in March, my pipeline of GMV is 300 billion actually. Because right now what's so interesting is, one, getting in is super hard. We have enterprise grade, you have to go through InfoSec, we have to do all that stuff. Like we kind of understand how to navigate the enterprise. But right now, once you get in and you get through the pilots, you get through all the stuff and you win trust, the moat's there. And now people want to iterate fast. So we've kind of passed this wave of, I don't trust digital or I don't trust AI. Now we're at the stage where all these marketers, e-commerce people, if you convince them that you want to be their AI partner, whatever niche you're going after in enterprise, I think it's super interesting. And so right now is the time to like get in the door, do whatever you need to do. But I think it's really, really interesting in vertical enterprise software than it's ever been before.
So I know we're going to go to Q&A in just a second here, but we are at the Korea Society. And one of the topics that we were going to discuss was the future of the Korean startup ecosystem, or to the degree that you invest in the Korean ecosystem, spend time building partnerships. What's sort of the prognosis there before we go into Q&A? And I'll start with Bryan, because you have the strongest positive opinion, I believe.
Irrelevant. Like we're a global venture company. We look at every deal everywhere. I've looked at Korea because I'm Korean. I love them. It's great. I meet all of them. I want to meet them. I want to hear about how they're doing. A lot of them do well, right? Like TOS actually is an example of a company that I wish we funded. It was before my time, so. But after that, we meet a lot of these other companies, and there are two issues with what I see. One is that they rarely escape Korea. I don't think I've seen a single use case of like a company that actually successfully broken out of Korea. Korea's like what, like, it's a big country, but it's like 11th biggest market in the world, and California has the 4th largest economy in the world. Like, what are you going to do with that? And there are obviously companies that do really well, but I think there are also investors that have made really good money investing in Korea, and they sort of marked up the valuation a lot. There's a lot of money internally in the country as well, so there's a high valuation expectation versus what they're delivering, and the total addressable market is Korea. So when they come pitch us, I'm like, hey, like we want X. I'm like, all right, cool. Like metrics look great. Like how much you want? No, I'd be interested in my mind. I'm like, oh, $20 million check maybe. Like we want 100. I'm like, whoa, why? I'm like, we have these offers. I'm like, okay, go take them. It's not going to come from global VCs, but take them. And that's what I've seen time and time and again. And now I saw it too many times to a point where I'm like, I'll meet them to build relationship and what have you, give them advice, et cetera. But from an investment standpoint, I have not made an investment yet.
I think what Bryan just asserted is all like accurate, like it's factually correct, right? But just to put a little bit of a more kind of optimistic, I guess, framing around it, there aren't that many countries outside of the U.S. and oftentimes it surprises people, but Israel that have actually consistently been able to actually export their tech, right? Even China's obviously struggled. So I wouldn't necessarily use that as kind of diagnostic of maybe Korea being a poor market. I do think in so many areas it's just nascent. Maybe nascency equals just the TAM's not there. Obviously on the B2B side, there hasn't been a lot of breakout successes. I think one area where prospectively we're really interested is actually manufacturing, right? So if you think about the old economy, right? What obviously helped propel Korea from whatever. I was born in 1982. I guess I'm revealing my age, but GDP per capita is I think sub 3,000 plus or minus, and today it's obviously 15 times that or whatever it is. So the sort of leadership positions that Korea has had in a number of really important manufacturing sectors, whether it's obviously shipbuilding, we were talking about that earlier today, obviously semis, EV batteries, cars, is really impressive. But from an automation, from a tech stack, from a willingness to pay and an adoption standpoint of digital solutions and specifically AI, we've observed that it's actually higher, right, than the U.S. and it makes sense. Like there's more industrial automation, robotics intensity is actually among the highest in the world, right? Certainly higher than here in the U.S. And so you have a lot of the raw ingredients actually for physical AI, for industrial AI opportunities that potentially could be backable. So that's just an area where we're spending a lot of time.
Great. I would say technical talent, great.
Yep.
Highest amazing talent.
I'm going to be a little contrarian here. So I think, it depends on how we're defining it, right? So if you are building a company in Korea and then you want to take, the TAM in Korea is just smaller, right? But what is interesting is out of all when we look at the biggest platform companies here, Google, Facebook, etc., they've penetrated all markets, except for China and Korea. And so it's kind of interesting when you look at Korea, you have KakaoTalk, you have Naver. Yes, Google's kind of there, but it's just not the same, Coupang, right? And so it's kind of interesting where you have a country that's growing rapidly in economic growth, and so maybe have a business there, or maybe you do something that's cross-border. I don't know. But what is interesting about Korea as and Korean people and kind of core competencies, if you will, I think that are interesting is, I kind of always look, if you guys understand the kind of the technology adoption curve, you have your innovators, early adopters. I look at that lens with everything. I actually created a company that did that, across all different verticals, et cetera, et cetera. In the world right now, more and more people are becoming early adopters and innovators because of internet across all sectors, right? And so I think what you do have in Korea that's super interesting, if you go back a decade or even before that, early adopters of mobile, early adopters of video, way before it was in the US. If you look at China and live TV, live shopping, it's kind of happening here a little bit slow, but there are trends, human cultural trends that start in Asia way before everyone else. I also think there's a taste factor and design factor. A lot of Koreans are very good. I went to art school and I dropped out, but it was all Koreans, and I was like, whoa, this is interesting. So I think design has never been more important in UX and consumer adoption. It's breaking into the enterprise. So I think there's all these really interesting strengths that are there, and it's just more of, are you building for the domestic market or a global market? And I think there's really core strengths and values that exist. I think Samsung's is a really great case study. When I grew up, and I'm old, I think I'm already, Samsung sucked. I'm sorry. And now it's so cool, and so there's things around innovation, design thinking, human-centered design, early adoption cycles, understanding in that short density of this country, you can scale very rapidly. I think with all the typos, it's complicated, to break through for other reasons. But I do think there's something really powerful and creative there. That's interesting that I'd be a little bit more open-minded to. I think it's different when you're Andreessen and you have to move to AUM. And look, I invest in beauty and all of that. And so I've seen, if you look just at the cultural shifts of K beauty, K drama. Like there is something there that is like I'm so proud of, and it's so cool that like I don't know. I feel like it's all about go to market. You know.
Well, that's an optimistic note. I know we're going to Q&A now. So Sojong and Sarah, I think are organizing Q&A. We have mics on the left and maybe on the right. So if anyone locally here wants to raise their hand and ask a question, feel free to do so. Someone is right behind you on your right.
I agree.
Okay. Great panel. Question maybe for Bryan, because velocity and all those things. So a company that tells you they got $1 million in one day, like how do you vet it? Because
How do you what?
vet the company that they're telling you the truth, right? We had these examples during the crypto bubble where, things were growing fast and you got all these fraud that happened, SBX, FTX, So how do you go through to make sure that they're really telling you that they have the numbers, and how do you verify that?
Yeah, we asked the founder very carefully, go hit the download button on Stripe and send it to us. Like that's literally what we ask. And they're like, oh, we'll present the data. I'm like, don't worry about it. Hit the download button, it's upper right corner, send it to us. And we just cut it and we look at the retention curve, we look at growth, we look at everything ourselves. So we look at the raw data a lot of times. And frankly, before we wire, we require P&L. I need to look at your P&L. And we require bank statement verification. So there are, guardrails that don't let us get trapped in the, areas. But look, if someone's completely psychotic and like made up everything, entered 4,000 line of Stripe in a fake way, like, look, like that's hard. That's hard. It's going to show up in bank statements. So hopefully we catch that. But we verify.
Thank you.
There you go. A question over there or there.
How do you think about the role of a technical co-founder, which was previously a must, in an age where LLMs are just so good at generating code?
I think even more important. If you don't understand technicality, if you don't understand the new models that are coming out and how that can be used for your product, that generally requires technical understanding these days. If you don't have it, I think it's very easy to fall behind.
I'll add that relatively speaking, if you look at college, graduation rates, Stanford, Harvard, 100 a year, now 600 a year. If you don't have the technical skills, your startup competitors do. And so there's just much more code, many more software engineers just in the ecosystem. And so most companies now are technical as opposed to 10, 15 years ago. I think there was another question in the middle there.
My name is Chase Sun. I'm a founder from Korea, operating and then running business here in New York. I had a question for all of you, actually. So Bryan talked about your shift in reviewing the momentum, the standards that you had before the agentic AI started rising, and then the standards that you have now. What else changed for the three of you from the investor point of view?
I have opinions. I'll share. I have opinions. One, I used to be a stickler for retention and the craft of like how beautiful and how thoughtful is your product. I wrote so much about it. Now it's out of the door. It doesn't matter. Not that it doesn't matter, but you don't have time. So if you're like the time you're crafting something, somebody like iterated 5 times and you're like outpaced. So that changed. The other thing that changed was technical founder. I don't think you really needed that. I'm like, oh, as long as you understand the mobile ecosystem, blah, 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 it's fine. You can't do that now. I think you do need a technical, bone in the founder. Third is, look, like before I'm from Snap, we eschewed all social media. We built quietly. I sort of changed from building quietly in the corner to like, actually, AI is too magical. There are too many witchcraft out there. So you actually, in order to make noise above that, you have to have a special skill to distribute, and not saying anything is definitely not one of them. So I've also changed on that.
I guess what I would say is just kind of going back to Karen's point about niche workflows. Our historically, like our preference would have been or our bias would have been, those startups that maybe have been very explicit about identifying kind of a low ego problem, right? One that might be perceived as small, but a very sort of clear problem that they can execute on, demonstrate tangible ROI, obviously build trust, and then the kind of proverbial layer cake strategy, right? Create adjacencies, upsell, cross-sell, so forth. I think in this new world, I think verticalization is even more important, except that unlike in vertical, SaaS, you actually have less of the sort of, conventional concerns around, the TAM being too small, right? Because ultimately, fast forward, hopefully 3 to 5 years, the profit pool that you're attacking is not just IT budgets and software budgets, but obviously something exponentially greater. So I agree with both people that like it is hard in this era of speed, product velocity to sort of identify moats, but at the same time, like moats can actually be even more sort of fortified with really sort of like understanding the contextual nature of certain workflows. Actually,
land and expand has never been more prevalent, and I think across the enterprise they're looking at vertical integration and consolidation. I think that's what we're seeing.
Totally,
it's super interesting.
Totally, and when you mention that point, like actually, there's this company that is public that I assume most people have not heard of, but it's been around forever. It's very much a legacy company, but if you were to plot like the 10 or 15 most valuable software businesses today, right? The usual names that I think we all know, the Palantirs of the world, Shopify, they would come up. But I think it would surprise most people that it's not actually that little, but a somewhat obscure company called Guidewire is actually in that list. When I talk about the most valuable, I'm talking about garnering the highest valuation multiples, right? Multiple of earnings, multiple of revenue, whatever it might be. Like they've been around forever. They're pretty niche, right? Because they're vertical software, not just for insurance, but like property and casualty insurance, right? So I guess in this era of hyperbolic growth, I think this is the topic of, I guess, the whole panel, but what is durability? And I think really sort of being embedded with very sort of domain-specific contextual knowledge is more important than, it's always been important, it's just much more important today.
I'll say before we started the panel, we were talking about it, but improvisation is a really important skill right now. The speed at which all this is moving is extremely valuable. I remember investing 10 years ago in SaaS, and back then it was like, you're a 30-something sales, maven in a specific vertical space. You had a CTO who was a co-founder who knew how to use, cloud infrastructure tools, and it was like X for Y, and there was a very clear path, and if you had good execution, you could work. Today in our world, your entire company can change in a month. And so if you don't have a CEO and a founding team and a leadership team that is able to pivot, improv, change business model, cobble together how to survive, like it's kind of like on like whitewater rafting, and you just have a panel or two and you're trying to survive. And so I think that skill set is much more valuable than it was 10 years ago. Nothing else? More questions? If there's no one else, we'll do another one if there's no one else. We'll go to you second. Or first. We can do you first. And we'll go back to you.
I'll stand, I guess. Did the AI hype cycle interest you in PQC a little bit more? And do you think PQC is going to become a hype cycle as well?
What's
PQC?
Post-quantum cryptography. I'm Lauren. Nice to meet you.
Can you repeat the question?
Post-quantum cryptography. So Gartner says, one of the initiatives and themes going on for this 2025 PQC, post-quantum cryptography, is in the books. And Korea comes in kind of handy. It has a competitive advantage. We just started something called Han. Initially, it was called Crypto Lab. So we just launched it this month. And I was wondering if, as we're in the Korea society, if anyone's interested in PQC because of AI, if that awareness has gotten a little bit stronger.
I don't know anything about crypto. I should have mentioned Korea excels at crypto. So that's awesome. But don't know much.
I would say Lux has traditionally had sort of an anti-quantum viewpoint over the last 10 years. I will say Project Willow with Google 6 months ago has changed a little bit of the dynamics. It feels still like it's an academic lab exercise as opposed to a commercializable opportunity. But it's something that, there's always a threshold from like science fiction to science fact. And so quantum seems like fusion and a bunch of other categories where, maybe we're just on the, cutting edge of being able to move between those two. But traditionally, we've been very, very negative on the quantum space. Please.
Yeah. So I guess so maybe follow up is we're talking about speed of adoption, user growth, hyper growth, etc. But we have not had time to really look at customer loyalty because it's very easy to switch. It's very easy to cancel your credit card subscription. And so what's your advice on really when you're looking at a startup and being able to see retention, all those things, so that you at least know that this is not going to be like a 1 year thing and it dies?
I think this is where design comes in. I think it's incredibly important. Just like whether you're enterprise or not, just like a really beautiful, like seamless user experience, it keeps people. I think that's just never been more important in terms of retention, I think, and usability. And I don't know, I think it's a tough one. This is where I'm like, for consumer tech and all of that, like I think it's never been more exciting because the adoption rates are really interesting, but it's also the switching costs are super high. And it's the same as like investing in a fashion brand in some ways. Like, what's the real moat? Which I'm like not, I work with fashion brands, but like I hate investing in fashion brands. Like people come to me all the time. I'm like, it's like the worst business.
Well, I mean, you're asking a question that we ask around all the generalized LLM models. Like, what is ultimately the moat? Is it team talent? Is it culture? Is it brand name? That just ChatGPT is what people, it's the Kleenex of AI, and therefore it will always be number one because that's what people refer to, or is there a moat?
I think the labs have moats, right? Like there are very few people in the world who know how to build these. There are probably 10 people in the world. Thinking Machine, Ilya at SSI, OpenAI, Anthropic, Mistral maybe. That's kind of it. Number of people how to build this is very, very low. So like technicality, I think there is a moat. I think the retention thing, again, AI is magical. And it changes too fast. Therefore, if you're not delivering value and not moving fast enough, people will churn. That said, if you are fast moving, what we're seeing in the numbers are actually, they're more retentive than before. They're more retentive than the SaaS and like sort of the mobile era of the companies. And what you actually end up seeing is not only more retentive and unique user count retention, but the dollar retention. It's a crazy concept. Like for consumer business, uttering the word of NRR, net revenue retention, is dumb. Like that doesn't exist. Mm-hmm. Which means that every month it's like some people are paying more than the months before. And that's because there are tiers of services, there are net new products you can put in the next tier. And so you see a lot of upgrade behavior. I used to have $20 a month OpenAI plan, now I have $200. I subscribe to 3 products that are all $50 each a month. So yeah,
I think that's interesting. Like the business model, even at consumer, has totally changed. The idea of credits,
changed.
Like you just have to think differently no matter where you're at, and that's super interesting. I think a lot of it started with like the early days. Like the image models and like buying credits every time. Like it's super interesting.
That's another thing. Like usage rate. Oh, another way you end up paying more is in like I bought a $20 thing, but you hit a cap. It's like, oh, if you want to keep going, like add more tokens. I'm like, all right, buy tokens. Not crypto tokens, inference tokens. Then you end up spending a lot more money.
Did you have anything on this, Mike?
No, I mean, other than it's like the crux of what we spend our time trying to figure out, right? Like, so it's really important. And to their point, it's it's not necessarily obvious, right? I mean, the quantitative kind of indicators are more straightforward. We spend, just kind of given our early stage focus, as much time, if not more, on the qualitative indicators, right? And some of that sounds pedestrian, but it's like really important to figure out, like just in terms of founder market fit, right? Like, do they have the kind of authentic desire to actually solve this problem? Is this something that they care about? Is there a track record of not necessarily success, but a commitment to that problem, right? That's one way to figure out whether they'll kind of demonstrate the resilience that's oftentimes needed.
We have some virtual audience questions from online. I don't know where the camera is. Hello. Gregory asks, the U.S. continues to draw the large majority of global VC funding, with Europe lagging in particular. Lots of hate for Europe. What are the main reasons the rest of the world, ex-U.S., is so relatively unattractive to innovators? Brian, it's going to go to you.
I have so many opinions. Europe's actually hot. Mistral, Lovable, 11 Labs, Black Forest Lab, Legora, like I can keep going on. Like actually,
Helsing. Yeah.
Helsing, yes. So Europe isn't as sleepy. Like 10 years ago, it was just Index and Excel cleaning up shop. Now all the global VC, like I go to Europe all the time because there are companies there. And so one, I think there is an actual reinvigoration of that. But the reason why I think the rest of the world is still lower in activity is essentially exits. We have this theory where not the limit, but the ceiling of the country's like exit typically is based on precedent. Meaning if there's like a $30 billion company that went public, like Spotify, out of Sweden, I think, you end up looking at Daniel Ek and like, I too can do that. Actually, Korea, we saw the same thing. Like SJ from TOS. I think someone offered him like $10 billion or some very large sum of capital to like buy the company. He said no. That's insane. That never happened before. That would never happen before. But it happened, and I asked him why, and he said, look at Bryan Kim at Coupang. He built a $100 billion company. I too can do that. So I think what's interesting is looking at the previous exits, and U.S. capital market is by far the largest and most liquid, and I think that has something to do with the activity in investing and exits.
I think we're in it's like a wave. So I grew up in California in the Bay Area, and but I started my first company here in New York. But all my investors were in Silicon Valley, and I went home for Thanksgiving, and that was just my network, anyways, because I built my career there in the beginning. But it was so interesting, my first startup, to see the New York ecosystem develop, right? So part of it is before you have the early capital going in, it's more like that comes from ecosystem. And I think part of it is the exits and the operators that learn how to build, 100%. How to operate at startup scale, not like old corporate. Like it really is different. There's something about someone who's learned how to design product at Google versus anywhere else. But so there's that from the talent wave, but then there's the exits and the angels. And so I think that matters a lot. What we're seeing in Europe is there's a ton of amazing technical talent, especially in Israel, but also in Spain, in France, and all of that stuff. But the angel markets were very slow. But now that there are some exits, and now that that's growing and there's more dollars coming in, but also the TAM of those markets are small. So when you look at it, at the end of the day, a lot of the people move here or there, and there's so much cross-border activity. But being close to where your customers are, or your market, or understanding that market, I think that's part of it. So, but I think a lot of companies, countries, and whatever can be successful. It's just, especially in this day and age where distribution is so vastly easy to do.
I mean, just maybe one synthesis of this question is like, the single biggest trend in all of kind of investing over the last 30 years has been this notion of American exceptionalism, right? So the question is that going to persist or not? Which is, I guess, a timely one. Just to kind of, add on to all the really good points, like, and Jeff Bezos talks about this all the time, right? Like, it's not just the size of the capital markets and the liquidity, but it's also the quality. There are very few places in the world where you, as a brilliant entrepreneur with no discernible track record, right, but some form of brilliance, can actually get a lot of money on an idea, right? And it's a little bit more, I'd say, fundamental, just in terms of the history of entrepreneurship, risk taking, that simply just doesn't exist in huge parts of the world. And then, of course, the exit environment is kind of intertwined with that, right? Like if you think about the whatever the top 20 most valuable companies here in the U.S., like most of them are actually brand new, like as in they were founded in the last 20, 30 years, right? Like that was not the case in the late 1990s. And so there's a self-fulfilling prophecy that, Elon Musk, for instance, Jeff Bezos, right? Like perhaps one can be the next Jeff Bezos. And if you have less of those reference points in your respective market, it's, I think a factor.
I will also say, to close that section out, I do think Europe is trying to get better at this.
Yep.
So we hosted 12 directors of screening, so people who actually approve investment, VC investments at the government level in 12 EU countries. And I asked, like, how long does it take to do the process for like a Series A check? And one of the Baltic states was like, well, it takes about 7 to 8 months. But we're working on it, and we're trying to get it down to like a week. And there was a huge amount of excitement around AI and being able to cut all the process out of all this sort of stuff. So in some cases, there are just logistical challenges. There are certain countries where it is just not feasible to invest. But I think those governments, even ones that you would be very surprised by, are working very, very hard because they want that capital to come to Europe in a way that I think 5 years ago they did not.
I mean, like starting a company in Switzerland, I'm like, the legal stuff is so confusing. I'm like,
Yes.
it's just so much easier in America.
Well, I got into an argument with the person
Yeah.
from Germany, but Germany is impossible to start a company. Like we have a couple of good ones that are coming up. I think Black Forest Labs is built in Germany.
Literally in Black Forest.
A couple of really good up and comers, but from a government bureaucracy perspective, very, very hard. Do you want me to do the last one? We have a question in the back. Yes, let's go to the question in the back.
I guess across your careers, you guys have seen a lot of different companies, probably prior companies, as well as the companies you're in now. Just curious, and you've seen also a lot of kind of like private companies versus public examples that, there's more information on. But just curious if you had any examples of like companies where there was something they did uniquely, either like to propel growth or to give a competitive advantage, and just something that you thought like, this is kind of interesting, and was actually, something that they kind of enabled them to kind of prosper.
Public or private, just any company?
It doesn't have to be anything you've invested in, just something you've seen where it was like, this company did something unique.
So I spent really the bulk of my career to date really in the public market. So lots of examples, and I guess I won't win kind of brownie points for creativity, but I think a really sort of well understood and powerful example would be Amazon, right? So companies that even at a reasonable amount of scale, depending on how you define scale, continue to sort of accelerate growth is to create sort of second acts, third acts, fourth acts, right? And that's like a really unique attribute that obviously the leadership team, there had. And perhaps the most powerful expression of that would be turning a cost center that was AWS into a profit center, right? So that's something that we think about when we evaluate obviously far more nascent and unproven businesses. But I think that's like a pretty good example of like long-term value creation.
Question in the front yes, question in the back. Just wait 1 second. For our live YouTube audience.
Hi. Hello? Hi. Have you ever seen companies that were able to gain a lot of traction when they were free, but when they started adding a pricing model, the traction dwindled? Or the customers fought back, or they started making their own thing, or
I can take this from the industrials perspective, which is I think a lot of people want to give away stuff for free and then backtrack the revenue later, right? So we see this in robotics over 10, 15 years where a lot of companies sort of said, look, let's get you installed for free. Let's get you ramped up for 6 to 12 months. And then you have a usage model that comes down the line. And what ends up happening if you aren't in like the capital budgeting of a company all the way through is that companies are shocked when they actually see the usage model down the line. They weren't expecting how much they were going to pay. And an earlier generation of robotics companies basically did rip and replace. They got ripped out of the production line and people went back to manual processes. And so I think what you're seeing with new companies is they don't make that mistake. They ask for money from day one. You see this in defense, aerospace, robotics, all across the hard technology companies. Nothing is for free. But in many cases, you're complementing that with a financial product. So for instance, if you need to buy a robotics company, like we have an example in our portfolio, Formic, they now complement the robots are tens of thousands of dollars. They're selling to mom and pop facilities that can't afford that. So they complement that with a financial product on day one. So it's a little bit like, GMAC for GM. Like obviously not everyone can buy a car. So if you offer the leasing product on top of the car itself, that's a very compelling package. But I think more and more companies across the board are trying to avoid free first.
I keep thinking of, when you said that, I don't want to call out a company because I think most of those have died, but there are companies that really had to figure out their business model, and a lot of times it's on a two-sided marketplace, right? Because you have two buyers. You have your end customer, and your supplier. And so I think it's about being really crafty in terms of how you are evolving, building in viral loops. If we think about Airbnb and reviews, and what are the ways that you're creating value on both ends? And one of the funds I'm in, we're trying to win ClassPass. I think that's a really interesting example. If you look at the evolution of that company from the seed stage to over time, there's case studies on this. They had to really adapt their model over time, to figure out. I think when they first started, it was great for the power user, but then it was tough for their early supplier market. And so in those markets, you really have to think about scale and how you're making the economics work for both sides. And so I think those are interesting case studies to look at as we talk about business models are changing. It really all comes down to incentive structures. And I think price is one of them, but also there's social currency and all these other things to think about.
I will also say before we go to the question, pricing has gotten so much more sophisticated than when I started as an investor 15 years ago. Back then it was trial and error, and people would come up with 3 tiers, and they would throw things in tiers, and it was totally random. Now there's an entire specialty of people who do SaaS pricing, AI pricing, e-commerce pricing, and it's really sophisticated. A lot of it is AI ML driven. It's built around real science, and there's a lot of, I would say, strategy on how companies will actually purchase, meaning you are targeting at the right fiscal cycles. You're not targeting companies that don't have budget. And so I feel like it's just gotten so much better than it was, so hit or miss 10 or 12 years ago. Do we have time for more questions, or one more question?
Yeah, to
5 more
question.
questions? 100 questions. I heard 100 questions. One more on the back there. Sorry, one more on the back left.
Hi, I'm Sophia Kim. I do strategic communications for founders and startups. But one question that I always wanted to ask is, what's your gut check question that you always ask yourself before you invest in a company?
Round robin.
Can this return to fund?
I'm always thinking you don't want, especially in a tech, you don't want someone who's thinking incrementally. So what is their crazy vision of the world that they see the world in a different light? And do you think it's possible? And do you think they're the ones to do it? So I think it's true coming back down to founder market fit and their ability to be self-aware.
A really important, kind of quality that we look for in founders, right? Just having that kind of unique insight that's orthogonal, that's differentiated, not, being contrarian for the sake of being contrarian, but just something different, right? I think as an extension of that, we want to identify one thing that the founder has done, even if they're obviously a first-time founder, where they're just N of one, exceptional, right? That doesn't mean being successful, but just something that where they feel like they're kind of in rarefied air. Could be anything. It could be a hobby. It could be an interest. It could be something that's less maybe serious, but that's something that we care about a lot.
I agree with all 3. One positive would be in-person sales as well as virtual sales post-COVID. So the ability to sell and convince a recruit, a sales target, another partner, a VC. The ability to be magnetized on screen is extremely important in our digital world. Then on the negative side, I always care about breath. Bad breath is a huge red flag on any deal. Means you don't have empathy, you don't know where you are, probably aren't showering. That may be okay in the earliest stages, not uncommon. But I will say, if you are meeting a client and you have bad breath, not a good sign. So brush your teeth. That's my Career Society message to close out our event tonight.
I think that's a great way to end this program, let me say so myself. I'm sorry to cut the program short, but I'm sure during the network session, you'll have more time to engage with the speakers as well. So I'd like to close off and say thank you for everyone for attending or tuning into this program. Thank you to Bryan, Karen, Mike, and Danny for sharing your valuable and candid insights. So before we officially end today's program, I'd like to share that we're collecting your feedback on this program. You can access the survey link in the back of the room. I think some of you guys might have seen the QR code. So 2 lucky respondents will receive 2 free tickets to the Career Society's upcoming happy hour event that's happening next Friday. You wouldn't want to miss it. So and you can also access the survey through the UMO event page, which I I'm sure that everyone had a chance to access before this event. So on that note, feel free to use the UMO event page to keep connections with each other, with us, the Korea Society, and to stay in touch as well. If you're here for the first time at the Korea Society, welcome. We have a lot of really great, amazing programs, not just in the business economics field, but arts and culture, policy, and education. If you'd like to join us as a member, a lot of great benefits. You can get exclusive access to our events, a bunch of discounts, and etc. So please feel free to join and ask one of our staff members if you're interested as well. So please enjoy the networking session and light refreshments in the back. And we hope to see you again soon at the Korea Society. Thank you.